One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's Nightmare Winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says, we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. That is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report we've put together about America's Nightmare Winter scenario. Get the facts for yourself. Go to AmericanWarning2022.com to get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, www.AmericanWarning2022.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is the 17th of November, 2022. And we got to break down this market for you. And we're going to break it down from afar, down here in Nicaragua. But we're going to break down the market and the sectors. Which sectors are poised to continue rallying? Which sectors may have given us a head fake on the upside? We're going to dive into that. We're looking at over 10 sectors, breaking them down for you. A must watch. And of course, what is going on with Bitcoin, FTX, CZ, craziness. We'll explain it all coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It is November 17th, 2022, coming to you from Nicaragua. You can't see the beautiful ocean to the right of me or the nice kitchen to the left of me, but you can see this nice picture behind me. So this will be our makeshift studio here for the next few weeks as I'm down here for the holidays. But as I mentioned, we got a big show because the market had a heck of a rally the last couple of weeks. Obviously, a lot of it is based off the Fed news, off the inflation number. And then the last few days, we've had a bit of profit taking. We've seen the market come down a bit. So is this just a head fake rally, meaning that it's just a bear market or a bear market rally, basically? Or is this a start of really the end of the bear market? We're going to dive into that for you. And we're going to jump right into it because I think we need to look at the charts right now and look at what's going on. And the first chart that we're going to look at is going to be the S&P 500, which is tracked by the spiders, the SPY. As you can see here on this chart, I drew a white line. That white line is what they call a downtrend line. It's connecting the lower highs. And the definition of a downtrend is a series of lower highs and lower lows, which we have right now since January in the S&P 500 when we hit an all-time high and rolled over from there. Well, the bad news is that another resistance level is the blue line you see in the chart. That's the 200-day simple moving average. We failed to get above there several times on these prior rallies. We came very close last week and failed. We're down this morning about 45 minutes in trading, about 1.1%. So coinciding with that blue line is the white line. So the downtrend line and the 200-day moving average are sitting around 405, let's call it, on the SPYs. We're at 390 right now. We got up to about 403 last week. So we came right up to resistance and we're failing right now. I don't like the action in the short term. We need to break above that downtrend line because when we break above that downtrend line, that is my ultimate signal that the likelihood of a rally retesting the highs in the next 12 months, if not sooner, is doable. And you might think I sound crazy saying retesting of highs, but I truly think that that is a possibility. So let's take a look at the tech stocks because the tech stocks have not held up as well as the S&P. But as you'll see here in a second, the Invesco QQQ, which tracks the NASDAQ 100, has a pretty similar chart. And I also drew a white line on this as well. And this is, again, the downtrend line, connecting the series of lower highs. Also, it has a series of lower lows. And as you can see, this white line, right about where it is now, is just above 300. You have the blue line, again, the 200-day moving average around 310. So that's the area we need to look at for the QQQs, for the more tech-heavy stocks. And as you can see, we still remain this downtrend. We did not break above it yet. So even though I think there's a lot of constructive things going on, which I'll talk about in the market, underlying the market, and I believe that there's a lot of great stocks that have bottomed not only recently, but months ago, the overall market, it's tough for the stocks to go too high without the overall market breaking out. So again, I'll keep you up to date on this as we go out throughout the weeks, because when we break that downtrend line on the averages, it's going to be extremely important for all of us to look at, because it is going to be a signal that it potentially is time to really shift more money into the market. So the third major index, of course, is the Dow Jones Industrial Average. Keep in mind, it's only made up of 30 stocks. But again, I drew a white line here, a bit of a different chart, because it doesn't have that pure downtrend line. But it has a line here, which I drew around 34,250, give or take. That was the high in August. We came just above 34,000 last week, before kind of pulling back here the last couple of days. And it's down about 300 points today, down about 0.8%. So it's not, 300 points sounds like a lot, but 0.8% is really not that much, folks, on a one-day move. So the level to watch here in Dow, let's call it 34.5, right around that white line, breaks above there. That is going to be a major breakout, but it has been outperforming the other indices, being above the blue line, which is a 200-day moving average, well above the red line, which is a 50-day simple moving average. So these stocks have held up much better. And there's one more chart I do want to show you. And this chart is really interesting to me. And it tells me a lot about where I think the market's going to be going next year and the year after. And this is IWM. This is the iShares Russell 2000. So small mid-cap stocks. Similar that it goes up to the blue line, which is a 200-day moving average, failed last week, down 1.4% today. But look at the white line I drew in the very bottom of this chart. This is very, very important. The last three charts I showed you, they all made lower lows, meaning that October timeframe, late September, early October timeframe, they broke below June lows. You can see here that the IWM, those smaller cap stocks, held that bottom. It hasn't broken a downtrend yet, but it held that bottom. And that is a huge, huge positive for the small mid-cap stocks. And again, when you're looking at individual stocks, I truly believe the opportunities out there right now could be once in a lifetime. I don't know if today's the bottom or yesterday's the bottom or tomorrow's the bottom in the market. I don't know that. And for individual stocks, I do know that we're starting to see some bullish underlying action in the small mid-cap stocks. And when you compare them to the larger stocks, they're becoming extremely inexpensive right now. And that is where you're going to find a lot of bargains, because when people go through a bear market and recession, and they give up on stocks, which all the sentiment indicators indicate that, even flowing through to some of the institutions. When they do that, typically they sell what they perceive as risky assets first, which is going to be perceived as small mid caps. So a lot of that selling has been done. And again, that's why we didn't see a new low in the IWM in September and October. We didn't see that because the selling was exhausted already in June. And we retested it, but we did not break below it. Where in the other major indices, we broke below it because there's another bigger wave of selling. So this is very important. There's not a lot of people talking about this, but this is something that we really, really need to keep our eye on. And it's good for our type of investing, because innovation is typically led by small mid-cap companies. So obviously there's large caps that do it, but it's typically led by the smaller companies. So that's going to take me into our sector review, and we might as well start with technology and take a look at that. But I was sitting here, I'm working on some writing as I'm down here, a lot of reading, and this kind of line popped in my head, and I wrote it down yesterday, and it's that innovation does not sleep. I said it last night to some friends at dinner, and they looked at me, and I explained it. I said, listen, you may think the world's terrible now. You may not like the political structure in the United States or Nicaragua or anywhere else in the world. You may think that inflation's crushing everything. You may think that unemployment's going to be an issue, whatever it might be, a thousand things. But meanwhile, there is innovation going on all around the world, creating the next Google, the next Amazon, the next Microsoft, the next Apple is being created right now. Innovation does not sleep. Does that mean innovative companies go straight up? No. They'll succumb to pullbacks like everything else. And a lot of times, bigger pullbacks than the overall market, as we've seen the last year. So I admit, our innovation stocks have not been doing well. However, it's a 1-year time frame. If you look at track records over the last 10 years, you can see my track record. How many, 10Xers I've had, how many doubles I've had. I mean, so it does pay off, folks. I want you to know that innovation does not sleep. It continues. And that means the stocks and the companies that are behind this innovation will eventually pay profits, literally pay you profits. All right, so let's dive into technology. And for the technology sector, we're going to take a look at an ETF. We're going to look at ETFs today because it's an easy way to look at it. And we're going to take a look at XLK. It's down about 1/3% today. So I just showed you what the indices are doing. So it's holding up much better. And the reason that is because NVIDIA, very large semiconductor company, which I love NVIDIA, reported earnings last night that were mixed. But a lot of analysts, and myself included, believe that the gaming sector of their chips that they sell really has bottomed out. And the data center actually numbers are pretty good. They did beat, on one of the numbers. So the stock's actually up today, and that's helping prop up some of the technology ETFs. So XLK, the chart here is very similar to QQQ. So we don't have to dive into this too much. But again, look at the difference between IWM and this. In October, we made a new low, but we're still in the downtrend line. So until we really break that downtrend line, again, you can be selective but not overly aggressive. The next chart I want to take a look at is within there, and that's the semiconductors. And as you can see here, it's up about 0.6% today. The symbol's SMH. And it's up again, like I said, because of NVIDIA. NVIDIA falls into the semiconductor category. It's done a little bit better here versus technology recently. However, heading into today, XLK is down 24% year to date. SMH was down 30% year to date. But lately, it's been holding up much better. And I think that October bottom, there's no way, I shouldn't say there's no way, there's always a way. The odds of SMH breaking below the October low are less than 20%, in my opinion. And again, you may think I'm crazy, and you may think that there's no basis to that. But I look at the valuations on the semiconductors right now. They're extremely attractive. And can they get cheaper? Of course they can get cheaper. Markets can always, the pendulum can swing so far that to one side, it really can whack people out and scare people out. That being said, folks, I don't think we break that low. So I think we've seen the bottom in the semiconductors. And again, still down 30% right now. So we're going to stay a little bit with the tech angle right now, but we're going to move into the healthcare angle of it, and that's the biotech index. And I'm pulling up here the IBB, which is the iShares NASDAQ Biotech Index ETF. Very different chart. We bottomed in May and June, formed a double bottom, and have not tested it yet. So it's held up much better. Down about 14% year to date. So again, much better than a lot of its technology peers. And as you can see, last week, we broke to the best level since mid-January. We did not hold that breakout, unfortunately, because that breakout's at 135 or at 132 and change today. But again, if we can somehow get above 135 with a sustainable breakout, I think the biotech sector right now is ripe. I mean, extremely ripe for a rally. One other thing I'm going to show you in a chart here is down here. This is the volume. It's red and green. You can see all the big spikes really since May to the upside are green. That means there's big money on big up days coming into the biotech stocks. Now let's match that up with IWM, the small mid cap. And I think right there you have a great investment strategy for a very small portion of your portfolio. If you want to be aggressive, start looking at small mid cap biotech stocks out there. I'm not going to name any today, but I think you want to start looking there. Let's flip over to just healthcare in general right now. And this one ETF that tracks it is the Spiders Healthcare. The symbol is XLV. As you can see here in the chart, XLV is only down 4% year to date. So it's held up very well. A very choppy chart at best. It rallied to a multi-month high last week, pulling back a little bit. But this is going to be some of the larger pharmaceuticals, not as aggressive. But it's been a nice place to kind of hide out, considering the market's down over 20% year to date, and we only have the XLV down 4. So I think it's a nice place to hide out. I personally, when it comes to healthcare, I'd rather do individual stocks. So XLV doesn't excite me too much, but it is something that we have to keep an eye on and look at. Now let's flip over to the consumer. And first, we're going to take a look at an ETF that tracks the consumer staples. This ETF is XLP. It's by Spiders as well. It's down 2% year to date. So again, holding up really, really well. And as you can see here, as of late, it had a big rally from October with everything else, but it's a choppy chart. So it doesn't really get me too excited. And again, if this market breaks out, you're probably not going to see money running into staples. I think they've kind of outperformed, and the valuations actually aren't that great when it comes to the consumer staples. Um, on the other side of the consumer is going to be consumer discretionary. And the ETF that tracks consumer discretionary is XLY, also by Spiders, down 30% year to date. So this has gotten crushed. And this kind of makes sense if you think about it, right? We have inflation falling back from basically 40-year highs. Even though we have people making more money than ever, we aren't seeing people save that much. We're seeing credit card limits hit like really mind-blowing levels. So people are pulling back on spending. You can't really pull back on staples because you need toilet paper and food and all that kind of stuff. But do you need another bag or more another pair of sneakers? Probably not. And that's where discretionary comes in, as the word says. The one thing I will say about this chart, again, bottomed in June, we tested in October, November, and we kind of held that bottom. But we're not far from there again. So I don't like the action here yet, but so far so good that we're holding the bottom. And again, already down 30% year to date as of right now. The next sector, I guess we can call a bit of a consumer sector as well. And this is going to be the home builders. This is the iShares Dow Jones U.S. Home Construction Index ETF, symbol ITB. And not having a great year either. ITB is down, I lost my numbers, 28% year to date. And it's just a really choppy chart. But again, the one kind of silver lining I see here is look at the October low. It's higher than the June low. That is really, really important, folks, when you see that, because the fact that we couldn't make a new low is important. On the flip side, I'll be honest with you, the fact that we have resistance between 62 and 64, we got to 61 and change last week and failed to break out on the upside is also a negative, or is a negative versus a positive. So we're in kind of no man's land right now. Again, it might sound weird me saying, okay, let's wait for the indices and the sectors to break out to buy. You'd be like, Matt, but you're paying more. Well, I'd rather do that and confirm it because I don't want to be in the business of trying to pick the bottom. And if it goes sideways for a while, it might be dead money and opportunity cost. But once something breaks out, it should run for a while, especially that we've been in a bear market now for basically a year. So when it does break out, you're going to see a sustainable rally that timely should last much longer than a 1-year bear market and last for several years. So I'm willing to wait and pay a little bit more for that confirmation. And for ITB, that's a situation that we're looking at for that. Let's take a look at the financials. And the financials are a bit of they're in a rough place right now, an odd place, not rough, I should say. So we're going to take a look at XLF, and XLF is only down 8% year to date. So that's actually extremely bullish. The reason that they've been able to hold up is because typically increasing interest rates, which of course we know interest rates have been going through the roof the last 12, 16 months, actually helps the financials because they lend money and the margins increase as interest rates go up. So even though they're borrowing at a higher level, they charge more to lend money out, and that margin in between of what they're borrowing at and what they're lending it at widens, which means their profit margin increases, which is good for the bottom line of financials. Typically, the regional banks benefit even more. However, a lot of regional banks deal with mortgages, and we've seen a huge slowdown in mortgages, so they've been kind of hurt with that, as do some of the large companies as well. The other counter argument to the bullishness of financials right here is the fact that if the economy is slowing down, if we are in a recession or not, I don't care what you say. It feels like a recession to most people, so let's call it a recession. If you're being in a recession, it's going to hurt the financials because the economy is not going to be growing as fast. So you kind of have to play both sides. Once the economy gets back to normal and interest rates kind of stay up here, I really think you'll see the financials take off. Again, on the charts here, it's back above that blue line, which is the 200-day moving average I like. But it rallied up to the 35 and a half to 36 level. We came close to there in May. We hit there in August. We hit there again last week and failed. Break above 36, I think the financials are setting up for, honestly, one hell of a rally. But I'd be patient with it right now. Then we have transportation stocks, and transportation is usually a cyclical business because it kind of tracks with the economy. You have railroads, you have trucking in there, so it's going to deal with the economy. I look at the chart here of IYT, which tracks the Dow Jones Transportation Index, and it's still in this downtrend. Lower highs, lower lows, can't get above that 200-day moving average. Came right up to in August, came right up to it last week and failed. The index is down 2% today, underperforming. So I'd stay away from the transportation stocks right now until something changes here in the near term. Then we have a sector that's actually done very well. And once I tell you what it is, you'll understand why. And that is the aerospace and defense. And the iShares Dow Jones U.S. Aerospace and Defense Index ETF, which is symbol ITA, is actually up this year. It's up 6% year to date. And again, you can see it on a day like this. I don't care what happens in one day, but it just showed you the transports, and they were down over 2%, and you have the aerospace and defense down 0.5%. So they hold up better on these down days. And as I mentioned, it's up for the year. This has obviously been doing well because of, unfortunately, the conflict in Russia and Ukraine. And there's a lot of, I talked about this a couple months ago, there's a lot of countries that really haven't even started yet, but they will really start restocking, unfortunately, their weapons because Europe, a couple months ago, there's a statistic that came out and said that Europe, their weapon stockpiles are the lowest we've seen in a very long time because they've been giving a lot of it to Ukraine. I can imagine the same things happening here in the U.S., and we're not getting, the world's not getting any friendlier, unfortunately. So you're seeing more countries. Japan's able to build basically their military force for the first time in decades. They're going to start spending. China obviously is not slowing down. So you're seeing a huge demand for aerospace defense. Again, unfortunately, I wish we didn't have to see this, but this is a sector. If it breaks above 113, it breaks out to a new high. That's a huge, huge move here for the ITA. But the aerospace defense has held up very, very well. The last sector of equities I want to take a look at is the gold miners, because people know how I feel about gold. And this is a GDX. It's the gold miners ETF. So it's a basket of gold miners. It has had a hell of a run in the last 2 weeks. It rallied to a multi-month high. It broke above the resistance at 27.5, but it's got a ton of resistance at 29. If you go back to September, December of last year, January of this year, that was a what they call a support line. When that's broken, it comes resistance. Last week, it came up to around 29.5, so we failed right at that resistance level. I still think we're probably going to see more downside for the gold miners here. And if you had to own gold, which I'm not, I would much prefer to own GLD or IAU and own the because it's too volatile, these gold miners right now. And if gold prices fall, they're going to continue to struggle. I just don't see it personally. And again, don't get mad at me. I just don't see it personally. It's nothing against anybody who likes gold. I have colleagues who love it, and I might be wrong. But just so you know, it's nothing personal. It has nothing to do with Bitcoin, which I'm going to talk about in a second. It has to do purely with my view on gold. I don't see it as a great asset class today. Could change, but today I don't see it. So that's where we stand with the sector. So I hope that helped. If you're heavy in one or looking to get in one, or whatever it might be, it can help your portfolio because. Remember, the key to investing, one of the many keys to investing, is using a top-down approach. So looking at where the market is overall, and then going down maybe into countries, and then looking at different sectors. And you want to be in the sectors that are performing well. So give you an idea of which sectors are poised to break out. And when they do break out, you want to be overweight those sectors. So again, I'll keep you abreast of what's going on with this in the weeks and months and years ahead. But again, I want to every maybe 3 to 4 months do a kind of a sector wrap for you to let you know kind of where we stand. Because sometimes you might be like, oh my God, I own these 2 stocks and they're underperforming. Oh, well, that's because the entire sector is going down. It's not just the stocks, it's a sector. And it can be on the flip side. Well, these stocks are doing great. Well, yeah, because it's riding a wave of a sector that's doing well right now. Aerospace defense is a great one. Energy. Actually, let's look at this real quick before I take over and move on to Bitcoin and what's going on in that crazy world. Let's look at one more chart because I wanted to end on this chart because I feel I always like to end on something positive when it comes to a segment. And this segment's obviously all about sectors. So let's end on the best performing sector of the year, up 70% heading into today. Of course, you know what that is. That's energy. And XLE tracks the energy sector. We hit an all-time high last week just for a little blip there and pulled back. But the sector still looks good, folks. It really does. I think we could have a little pullback in energy right here. I think we're a bit due for a pullback in the energy stocks. That being said, I still think there's a place in your portfolio for them for the next couple of years because a transition to clean energy is going to continue to lag. We'll get there, but it's going to continue to lag. And my team and I are actually writing about that for our next newsletter in December for the McCall report. We're writing about this, about how there's a great opportunity in the clean energy stocks, that especially some of the beaten up ones, but there's also a great opportunity in the old dirty energy stocks at the same time. You would think they'd meld together, but they both provide energy. We need more energy, and you're going to see a lot of great opportunity playing both sides of that barbell, if you will, approach to investing. So I want to talk about Bitcoin now. What's going on? FTX obviously was a fraud. I'd say. I mean, okay, it's not obvious. Allegedly was a fraud. To cover my ass here, allegedly was a fraud, and it's not looking good. I tell you a story, and I'm not going to name any names, but I came down to Nicaragua last week. Ran into a friend who's been building a crypto fortune, if you will, over the last 10 years or so. One of the smartest guys in it. Always kept his money off. Didn't put any exchanges. And he happened to do something just in the last 2 weeks, some trade, and he used FTX. His entire fortune, every dollar gone. And he's not the only one. I mean, what really kind of bothers me hearing my voice about this is these are real people. It's not just, oh, FTX is gone. The guy, SBF, who was worth 32 billion, is now worth basically nothing. Well, it's not about him. It's about the people who truly put their hard-earned money on there, and it's gone. It's really, it sucks, and it gives the industry a really bad name. But I've said for years, at the end of the day, of the thousands of tokens out there, there's only going to be a couple that actually really are worth anything, that are true projects. And I still believe that. But I still think there's a lot of great projects out there and a lot of great tokens out there. Bitcoin's down to 16,500 now. Remember, it hit a high of 69,000 at the high, down to 16,500. We saw CZ, the head of Binance, who has kind of been going back and forth with the FTX guy, come on CNBC this morning, and he spoke positively of the crypto markets, and basically said that I think he called FTX a fraud, if I'm not mistaken, and that Binance is fine, they're okay, it's not the same. But the question is, who's next? What's the contagion? How's this spread from the FTX? There's rumors of crypto.com being in trouble. Rumors. I'm not saying they are or they aren't, but rumors out there that they are, and a couple other firms too, not as big, but a couple of firms that had exposure to FTX. So you're seeing that ripple effect go through the crypto markets. You're seeing ripple effect go through the crypto related equities, whether it be the exchanges or the miners or anything really related to it. The banks that are related to it are getting hit. I don't know when this ends, though. I think it's going to be soon, because I think you're really going to see this kind of wipe out all the bad players, or majority. You're always going to have bad players. Majority of the bad players. I'm not saying you run out and you buy Bitcoin today. If you own it, I'm holding it. I own it. So I'll be honest with you, I'm holding here. I don't think selling right here is the right move. Again, we could continue to drift lower. The more news could come out 10 minutes from now. I feel like the news doesn't stop. But at some point, you get to where it's that kind of capitulation, like, okay, we got all the bad actors out. People have been asking me about Coinbase, and I'll pull up the chart here of Coinbase for you. Obviously, it's a publicly traded company. It's a very large exchange based here in the United States. And when it comes to Coinbase, and the CEO was on television last week, I was watching it, and he made a great point, is that because they're based in the States, they are regulated. They're a publicly traded company. So by audited one of the big four. So those numbers and the balance sheet and the cash flow and everything you see there, they don't lend it out like FTX and some of these other exchanges did. Much safer. Again, I'm not saying buy Coinbase here. You say look at the charts at 47.61 right now, down 2.5% today. It's kind of a billion base around 40, 45. I'm not saying you run and buy it here, but I'm saying in the longer term, even intermediate term, I think this will be good for Coinbase because they are regulated and we want to see some regulation in the market. And, whether you use FTX or you did use FTX or use Binance or any other crypto exchange out there, Coinbase is head and shoulders above a lot of those because of the US regulation, because it's publicly traded, because it's audited financials. And sure, audited financials can be monkeyed with too. I mean, it can. You can see fraud anywhere. I just don't see that with Coinbase. And I think they're going to be fine. Their exposure to FTX, they came out and said it was extremely minimal. So I think at some point, Coinbase stock is going to be a great buy. I don't know if we're there yet because I don't know if all the bad news is out in the industry. But I will say, I think there's something to it at some point. And if the crypto market does start to rally at some point, Coinbase should see a massive rally. I mean, keep in mind, Coinbase was just under $80 a share about a month ago. And now we're at $47.91. I mean, just to get back up there, you're looking at about 75% rally. And it's still well below the highs of $365 that it hit last November. So I do think there is something going on here. That there will be some opportunities. Not a lot because it's going to be very picky, but I think Coinbase will be one of them. Again, at some point, I'm not saying run out and buy it now. And again, keep in mind, nothing in this show is a buy or sell recommendation. I had somebody go at me on Twitter recently by saying, I shouldn't be, he bought stocks I talked about. I always say, these are not recommendations. If you're a subscriber of mine, we give out recommendations. These are just, I'm trying to educate you. And and make you a smarter investor and share the news and give you my views of it. Again, I always say I don't run out and buy it. If you like a stock, do some due diligence, and it's on you. But I'm just trying to show you what's out there and what's going on. So please don't take these as recommendations because they're 100% not. They're not at all. But I want to wrap it there because even though it's not the most positive note in the world. It's something we had to talk about. And I think when it comes to cryptos, I don't think they're dead. I'll tell you that. I think there is something to them. And I think they will be okay. It just makes some time. But I'll show you one last chart before we wrap because I do always want to end on an optimistic note. And that's NVIDIA, up about 1.4% today. And all this mess that's going on in the market, I really think this is one of the best semiconductor companies out there. And I don't think there's innovation in the next 10 years without NVIDIA. I think this is I think it's $1 trillion company. I just think it really is a leader in GPUs and semiconductors. I think this is a company. Again, it could pull back and hit new lows. I don't know in the near term, but I love this company long term. So we'll end it there. But thank you so much for watching. Hope everybody has a wonderful, safe weekend. If you're back up north, I apologize. Stay warm. I'll try not to get a sunburn while I'm down here. But again, I'm Matt McCall. Thank you so much for watching, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.